It is 10:30, so welcome everybody. Thank you all for coming. Got lots of people here in the session and I'm really excited to be here with you. What we're going to do this hour is walk through some of the SIE content and the questions that have been coming in. And I'm really excited to be able to share some insight with you and with the group. My name is Dave Meshkov, one of the managing directors here at Knopman Marks, and I know that it's a tough time right now to be preparing for these exams. And so I'm seeing a lot of the questions that people are posing. And if you just got in, I'll invite you to participate in this session with me through the question pane. Now, the question pane is designed for you to ask questions in, but I'm going to use it more as a chat feature. I want you participating with me. I'm going to pose questions and I want you to be interactive, actively engaged here. So feel free to be chatting in that question pane. I may respond specifically to you. I may respond verbally to the group at large, but that's how we can keep this fun. That's how we can keep this interactive. And that's going to be the way you get the most value out of our session today. You may see me looking off to the side. That's where my control panel is, so I can see the questions and anything that's going on with the system. So that's why I'm looking over there from time to time. With that, let's jump in. Let me talk a little bit about some housekeeping items. Today's agenda is going to be a quick intro on where we stand with test centers, a little bit about just perspective, real quick breathing exercise to get us all in the best place to learn and retain the information that we're going to be working through today. Going to talk about Tom Kelly, my colleague, who is a master at teaching this stuff, and one of the resources that we're rolling out for folks like yourself so that you can continue to prepare and learn in this time period. Then we're going to jump into some of the content that I got in replies from the registration page. When you registered for the session, one of the things I asked was, what is the stuff that you want to talk about? And so I heard from a number of students, economic and monetary policy. So I pulled some things that I think are going to be testable there. Bonds always showing up, tax advantage accounts showing up. So we'll hit some retirement stuff, college education, savings account stuff, and then options as always. We did options a bunch last week, so I put that down at the bottom. We may not get time for it, but that's okay because we will be able to do this again next week, and we can make that one all about options if that's what the group collectively wants to know. Let me just scan the questions real quick before we get in. How to get the audio working? Can hear. Audio is working. Make sure you're dialed in. Now, when I say dialed in, you can't actually call in on the phone. You have to use your device's Wi-Fi, and you should be able to stream that as it goes through. So with that, just give me one more confirmation. By and large, can people hear? Generally, people can hear me, yes? All right, great, thanks, Angela. Jenna asks, will these notes be available afterwards again? Yep, absolutely. This working document we create, I will send out along with the recording. Now, if you were here last week, the link to that recording has expired, but I changed the platform so that everybody could get in. And with that, we will be able to, those recordings will just be evergreen. So they're just gonna be there for the whole time. Great, I can see that everybody can hear, and I'm glad for that. And that means let's jump into it. So a couple of the housekeeping items. We've got continued uncertainty surrounding what the future holds at large and with respect to these exams. I know that's challenging and I know that's frustrating for you and for me as a coach and a teacher on this material. The test centers remain where they were last week with a intended reopening date of April 16th, but in my opinion, as we see the ongoing shelter-in-place mandates, as we see the uncertainty surrounding social distancing and what the right governmental response is, with safety being really everybody's priority, I think we have to prepare at least for the possibility that that date is going to extend out. So what do you do with that information? Well, it really doesn't change. We can only do what we can. We can only control some things. We can't control when the test centers reopen. We can't control what's going to happen with the larger economic impact of this virus, but we can control what we do. And we can control ourselves to be prepared to take these tests when we're able to do so. We can take this opportunity, if we have more time, to learn and study this content and other material to better ourselves. And that's the approach and the stance that I recommend that you all take. I'm so glad that you're here with us today, because if this is what you're trying to do, if your goal is to pass these tests at the time that you can, this is the stuff you should be doing. It does also come into question. People are asking things like, how much studying should I be doing every day? How should I balance and use the resources There's lots of resources. And so what's the right balance there? One of the things that I've been coaching on is, to the extent that the SIE is a priority for you, that you want to be in a position to take this as soon as you can, the goal should be to get yourself into a position where you are exam ready. All right, hold on here, I'm seeing some stuff. A little bit of froze fruit. So you want to get yourself in a position, let me say, okay, great, thanks, Bethany. You want to get yourself in a position where you're exam ready. That's kind of the primary goal. You study at the pacing so that you can get to the point where you're ready to take these tests. And from there, you're going to do exam maintenance. And remember, that means 30 to 60 minutes every day if you can, every other day minimum. Just getting involved with the content, short quizzes, review the flashcards, review the video lectures, review your textbook, do something to keep this information more top of mind. That would be the approach I would take here. Let me talk about Tom for a minute. Tom Kelly is one of my colleagues. He's been teaching this content for literally decades. He knows this stuff inside and out. He worked in the industry for a long time, has a huge amount of knowledge and insight on the SIE, the Series 7, other exams that people are going to be taking. Now, we are holding office hours where Tom is conducting opportunities for students like yourselves. If you have our study material, to reach out to him, you can do so right here at tom@knopman.com. I'll be sending this document out, so you'll have his email address. You can reach out to him with questions specific to the SIE, and if needed, schedule a quick call or check in with him to ask any specific questions that maybe we didn't get a chance to talk about. And so Tom is a great resource, and something that if you are preparing for these exams, that you would be well served to consider. Last thing we're going to do before we jump into the actual content here, a real quick breathing exercise just to get centered, just to get calm, get the energy lined up for you to be receptive for the information we're sharing. It's going to help keep you calm. And then, this is the key point, what we talk about, you'll have better recollection of, better clarity for, and the information that will be more available as you're drilling and practicing. So it's just 3 deep breaths in. If you can stand up, I invite you to do so. I'm standing now here, and we're just going to say 2 or 3, 4 seconds inhale, pause at the top, let it all out. I like to do it loudly. It just feels better for me, so I invite you to join me in it. Here we go. Breathing in. 2 more times. Breathe in. And the last one, make it count. Really fill up with air. Hold at the top. Let it all out. Let that oxygen hit your blood, hit your brain, put yourself in the best learning position. Already, for me personally, I feel more clarity. I feel more calm. And that's a good thing to feel in this current environment. Okay, with that, let's jump in. We're talking some of the questions we saw on economic and monetary policy. These are items and questions that we've seen show up on the exam that I want to make sure you're with. Now, stick with me, participate in the question chat box over there, and let's talk about demand elasticity. And what they're going to talk about on the SIE is about a commodities demand elasticity. And so as prices change, here we go. If we have a demand that's elastic, as prices change, what happens to demand? Change or not change? Change or not change? Go ahead and chat it into me. If it's elastic, just seeing 1 or 2 comments here. People chatting them in? There we go, Cynthia, Angela, Gabriella, good. We're gonna see that demand will change, right? And you just wanna be familiar with the terminology here. So if we have elastic demand, that means the demand will float up and down based on the pricing and the availability. Now, they're gonna flip it, and there you go, Michael's got it. You know the next question coming. Gas, elastic, or inelastic as a general matter, commodity? Elastic or inelastic? So I want you to be able to both describe and define, and then a little bit of application. Emma, you're unable to access the chat box. It's a question box. It's the question box. So what do people think? Gas. When gas prices go up, do you keep buying gas? When gas prices keep going up, are you still buying gas? Let me see here. I can't get down fast enough. Yeah, inelastic, right? It's inelastic. Prices go up, you grit your teeth and keep buying, right? So it's inelastic. Your demand for gas doesn't change as the price fluctuates. Now, ice cream, there you go, that's going to be more elastic. If it turned out a pint of ice cream costs $20, people are going to stop buying it, which means there's elastic demand for it. Now, mint chip for me, not elastic, mandatory. I'll pay whatever I have to get my mint chip ice cream because that's what I do, right? That's what I eat. Most important thing in my life. So that's not totally true, but you get the point, right? Michael makes another point. There's good alternatives to ice cream. Maybe you buy a chocolate bar. Maybe you buy something like that. Somebody says pass on mint chip. Well, that's just crazy. That's crazy bananas. Okay, let's continue on talking about more test points on the SIE. We got a recession, we got a depression. Definitional. Tell me, recessionary period, what are we looking at? Give me a definition that works for you. Key terms. There's just a thing, you got to see recession and boom, test point comes right to mind. What is it, gang? Perfect, I'm seeing it. 2 quarters GDP decline. Depression, how many? Depression. We're going to be looking for 6 quarters of GDP decline. This is the one to focus on for the exam, the recessionary period. That's what I'm going to focus you on. All right, good. Let's keep pressing on. Tell me about these 2 interest rates. The discount rate versus the Fed funds rate. Who knows what the discount rate is? And what I like about this particular way we're doing it is this is a little different than multiple choice because you have to be able to articulate, you have to be able to come up with the answer on your own. So let's talk about the discount rate. What is the discount rate? Who's lending? So let's do it this way. Lender is who? Borrower is who? The discount rate. This is the Federal Reserve lending to banks. The discount rate is what the Federal Reserve will lend to member banks. Anybody know what it is now? Is it higher or lower? It's going up or down? Right, this is going down. We're at the Fed, the discount rate right now is 0.25%. That's what the Federal Reserve will lend to member banks. Maybe many of you work or will be working for firms that are part of the member banks who can tap what's called the discount window and borrow at that rate. Now, let's talk about the Fed funds rate. What's this? Who's my lender? Who's my lender? And who's my borrower? Who's my lender? Who's my borrower? Bank to bank. Good. This is bank to bank. Now, what do people think? This is a key point. Is this targeted to be higher, same, or lower than the discount rate? The Fed funds rate is going to be lower. This is what the Fed is going to be hoping that the member banks will lend to each other. So imagine you're a bank and you don't have enough reserved capital. You're a bank and you run your calculation. At the end of the day, you realize you don't have enough cash on hand to meet the reserve requirements that you're needing to have. And as a bank, you need to get more cash before you shut it down for the day. You have choices. You have an option. You can go to the Fed window, to the discount window, and borrow at the 0.25% rate. But you don't have to borrow from the Federal Reserve. Before you go to the Federal Reserve and borrow at 25 bips, you would go to your competitors, your peer lenders, who might have excess cash on hand. And if you have more cash than you need, what are you going to do with it? You're going to try and lend it out overnight, super safe, from one bank to another bank, but you have to do so at a rate that's more attractive than 25 bips. If you said, I'll lend it to you at 30 bips, they'd say, no, I'll go to the Fed discount window. And so this rate differential is the difference between where the Federal Reserve says, we're going to lend at 25 bips at 0.25%. So anyone who wants to undercut us to make lending, to make borrowing a little bit cheaper can do so. And that's where they set what's called the target Fed funds rate. This is our lowest rate. Then comes the discount rate. All right, then comes the discount rate. All right, good, 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 good. All right, just looking through the questions here. Prime rate and broker call. Okay, yeah, let's talk about prime and broker call. For exam purposes, broker call is going to be more important than prime. Tell me about the broker call. Who's borrowing? I mean, I started with lender, right? So who's the lender? Who's my lender? Bank lender to who? What other kind of financial institution are we talking about here? Bank lender to broker dealer borrower. And you want to think about this in connection with broker dealers historically didn't have bank affiliates. So maybe some of you just saw this example only kind of works, but maybe some of you just saw that Morgan Stanley bought E-Trade. Well, historically, if you were a broker dealer, what you did was you provided brokerage services. You were the kind of entity that a person could come and they could place trades in the stock market. But if they wanted to trade on margin, you didn't have money sitting there. You didn't have deposits. So the broker dealer would go to the banks in the industry and say, hey, we need to borrow some cash. And the broker dealers would borrow at the broker call. The broker calls in cash to turn around and give to the customers. But tell me this, guy. Can you see my board here? I'm thinking about using this board. Let me find my marker. Here's my marker. You got the bank. They can borrow at the discount rate or Fed funds, lending to broker dealers who are borrowing at the broker call, who are lending to customers who are buying stock on margin. Can people see that, or is it too small? Too small? Okay, so won't use the board anymore. But basically what I just drew, and I'll put it up here, is bank borrows at the Fed funds or discount rate, gives it to BD, borrows at broker call, who lends to customers who borrow for margin at their margin rate. There's not a specific term for that. And so this is the same thing as what's on the board. So don't worry about the board. Don't worry about that. All right. So that's what we get. Now, when I borrow money from the broker dealer, it's the margin, it's the broker's call rate plus a spread. So it's going to be margin rate equals broker call plus spread. So maybe it's 100 pips, 200 pips, 300 pips. And that's the way that the interest rates go up as the money gets further and further away from the source. Oh, thanks, Michael. No coughing on my part. I've been by myself. All right. What else have we got here? What else have we got here? Let's talk about the yield curve. I got one more question here. So who sets the Okay, so a couple questions here that I think are kind of interesting. Who sets the discount rate? Let's put it as questions. So who sets discount rate? Fed or market? Who sets the discount rate? Fed or market? Fed sets the market. Okay. Who sets the Fed funds rate? Fed or market? Market, but here's the thing, but it can't really go higher, and this is for the exam, than discount, because what would you do if it did? If it was higher than the discount rate, what would you do? You would just borrow from the at the discount rate. So this is the lowest, then this is the second lowest. Somebody asked about prime. This is what banks lend to credit-worthy borrowers. But it's not defined necessarily, the prime rate. You know, different people will be able to borrow. A lot of banks can't borrow from the Fed directly. That's true. The discount window is only available to Fed member banks. But those are our biggest banks, and that's going to be the impact for the exam. All right, good. Next economic setup is the yield curve. Tell me, what is the yield curve plot? What's it plotting over time? What does the yield curve plot over time? Treasury yields, good, Angela. Interest rates, good, Max. Exactly. So it's yields, typically treasuries over time. And here's a yield curve for you that I grabbed from today. If you were to go and pull the yields on the 1 month treasury, 3 month treasury, 1 year, 2 year, 3 year, 5 year, exactly, right? Pushing all the way out. You can see that the further we go, the higher the rate. What kind of yield curve is this right here? The blue one, today's yield curve. Where the further you go out on the curve, the longer you are in the curve, the higher the rate. What kind of yield curve is that? It's a normal yield curve. Good, Angela. Good, Katie. Good, Blaine. Normal yield curve. The normal curve sees short-term lending, short-term borrowing, right, having lower interest rates because there's less risk than the long-term borrowing where you have more risk, and so you'd expect a higher interest rate. Now, notice you can look on this graph where we were last year, 2019, and 2 years ago, April 2018. And I want to look at the April 2019 yield curve. Notice all the rates were higher. I mean, rates are incredibly low right now because of the economic circumstances we find ourselves in. So let's take a look at the April 19 yield curve where we see the starred line here. And what's interesting about this? What's interesting about this? 1 year ago today, what was the yield curve? How would you describe it? Anybody? Inverted. Good. It's inverted or flat, they might call it. But the whole point is, notice short-term borrowing had a higher interest rate than medium-term borrowing. So it's flat, it's inverted. What it's not is normal. 2 years ago, normal yield curve. Right now, normal yield curve. I mean, these rates are really low, but short-term has lower interest than long-term. That's normal. When we see the inverted or the flat yield curve, that's indicative of the market's concern of upcoming recessionary periods. That is the market saying we have concerns about this period, and there's lots of people buying the bonds in this middle zone. That's what we're seeing in this particular chart, depressing the yield. As the price goes up, the yields go down. Bethany asks, inverted, flat, humped, all synonymous. Yeah, I think you can use those terms pretty interchangeably. Inverted, flat, humped, all are not normal, right? So if it's flat or if it actually is sloping the other way, that would be indicative of recessionary periods. All right, great, gang. Good, good, good. Let me see if there's any outstanding questions for me to hit here. Okay. All right, feeling good. Let's jump into some bond stuff. Here we go. We're talking discount premium bonds. What is a discount or a premium bond? What is it referring to? It's a comparison of what? What's it a comparison of? Discount or premium compares two things. Who knows what they are so we can make that decision? Prices, good, versus prices versus par. Excellent. That's the comparison, straight up, nothing more, nothing less. It doesn't actually look to the interest rate of the bond. It doesn't look to the other components. It is, does this bond cost more than par, premium, par, it's at par, or less than par, discount bond. That's it. Tell me, what do you think? As prevailing interest rates have fallen dramatically, right? We just saw that the current Fed funds rate is 0.25. If we look to the interest rates now versus a year ago, we've seen interest rates have fallen. What has happened to the price of many outstanding bonds? What's happening to the price of bonds as interest rates are dropping? Bond prices are up. We have more discount or premium bonds right now? Would you expect that there's more discount or premium bonds right now? Exactly. We've got more premium bonds in the market because we got more bonds like the ones issued last April or 2 Aprils ago, where they were some spread above treasuries. They were all up here somewhere. Those bonds are looking really good. Those bonds are looking good. Why? With rates so low, why did existing bond prices go up? This is the kind of SIE stuff they want you to know. What's this inverse relationship? Why is that the case? Can you articulate it? Because remember, on the exam, one of the choices is going to be there for you. But if you can actually explain it, if you could teach it, if you could tell somebody, oh, you know, it's kind of interesting as interest rates have fallen so much in the market, what has happened to the prices of bonds? Those bonds with the higher coupons, right, higher than new bonds, are more attractive. And investors prefer those higher coupons and will pay for them. But we got another thing happening. What do you think? What describes the ability of borrowers to make their interest and principal repayments? What risk has gone up that might push the price of a bond down? What risk is becoming a bigger concern for people who invest in bonds? Good, Bethany. Good, Jessica, Katie, Christiana, Angela. Excellent. Credit risk. Credit risk. Boeing was, what do we call it? What happened at Boeing? Macy's, Nordstrom's. Who else got this? S&P or Moody's did what to them? There's a term. Their credit risk has gone up, and as your credit risk goes up, the value of your bond is less because maybe you're not going to pay it back. So what are we seeing here? Downgrade. Good. They were downgraded. And sometimes on the SIE, they literally want you to know these kind of terms, right? That a company's credit, its paper, its debt was downgraded to a lower rating because we don't think they're going to have the future cash flows to make the interest payments or make the principal repayment that they needed. Let's talk about call risk. Somebody mentioned that. Call risk is a risk that a bond will get, and this is not that helpful as a definition, called. What is called? What happens when a bond's called? Good. Seeing a lot of good answers here. A bond gets called, it's good, and it's retired early. Yeah, the issuer takes it back, Max. That's exactly right. It's redeemed or repurchased. Good. Redeemed is a good word here, right? And so let's just run through it. The investor gets what back? And the issuer stops what? The investors get back par, stops making interest payments because they no longer are borrowing your money. Okay, now let's take it to today's environment. Putting aside some of the more complex market circumstances we're in right now, Do you think, all things being equal right now, with interest rates as they are, go back to that yield curve, right? This is treasuries, and usually the spread again is against treasuries. Are more bonds going to be called now? Is the call risk up or down? Current call risk. And again, I don't want you to think too much about it. Current call risk, up or down? All right. Let me see here. Here come all the answers. Good. Max, call risk is up. That's right. There they go. Good, Ted. And why? Good, Gabrielle. Refunding. Excellent term. Right? Redemption is when you pay it back. Refund could be another term for this. And what are they potentially going to do? Risk is up because they will reborrow the money. This is the whole key, at the now lower interest rate. So somebody asked a good question. Don't they need that cash? Don't they want to keep that cash right now? And the answer is they're not actually going to just give back the money. They're going to replace the money. I had the debt at 5%. My banker calls me up and says, hey, Dave, we can get you that same amount of money and you only have to pay 3% on it. And I say, great, give me the money at 3. I take all that cash and now I have double cash right now. Now I have double money. And I take it all and I call in those other bonds and they're gone. So at $100 million of borrowed money at 5%. I refund the debt. I bring in another 100 million, but at 3%. And right now I have $200 million that I borrowed. What do I do with that first 100 million the second 100 million I borrowed? I take out the loan at the 5%. I still have $100 million that I borrowed, but at 3%. Does that make sense? All right. Elena, I got you. I can see your questions coming through. People with me? Blaine asks, is a refund just like a refinance of a mortgage? Absolutely, it is identical. When rates go down, you borrow the same amount of money you have outstanding, maybe you borrow more, but the idea is you're going to borrow that amount of money and you're going to use it. So for a brief moment, you have both sets of money. Now, in reality, most of the time, the lenders don't even let you touch it. But for us, think about it. I've got the 100 million, I get another 100 million, I've got 200 million, I don't want 200 million, so I take that and I pay back the first loan. Good. Good, good, good. Okay, pressing on. What else have I got for you? Yields. Yields. Let's talk about this. This has to be a chart. All right, so we got the discount bond over here. We got the premium bond over here. We got the nominal, the current, the yield to maturity, and the yield to call. Let's talk about, let's see here. So risk is up because companies are more likely, sorry, so there's just a question about why is call risk up? Call risk is up because companies are more likely to redeem currently issued bonds and reborrow at lower rates, which is better for the company, exactly, but worse for who? Adil, who's it worse for when the company who's borrowed money from you at 8% or 5% now can borrow at 3%? It's good for the company, bad for who? The investors. You used to, actually, and this is going to tie it back to another point, you used to be clipping your 5% coupons and you were happy. And then the company serves you a notice that says, hey, by the way, the end of this coupon period, we're going to pay you your last 5% coupon, and we're going to give you back $1,000. So thanks for being our lender. We really appreciated it. We hope you liked it too, but we're done. And then you go and you see, oh my gosh, that same company is borrowing money at 3%. Like, I used to have a mortgage from Chase, and they lent me money at 4% to buy a house, and now I'm replacing that 4% mortgage with a 3% mortgage from Wells Fargo, as an example. Chase is sad. They used to be getting 4% from me. But I, the borrower, am happy because now I'm only paying 3%. Getting a note that it keeps freezing. Other people getting my froze fruit. Okay, it's here and mostly it's good. All right. So what I want to now talk about is this reinvestment risk, because it ties it together. So what kind of circumstance do you have reinvestment rate risk? Let's say you have a 5% bond earning how much per year? 5% bond, how much are we getting per year? How much am I getting each year? We're going to get $50 per year. Good, right? We're getting $50 per year. Now, similar bonds, interest rates basically, are only paying 3%. What are you going to do with your $50? The amount of risk that you were willing to take allowed you to comfortably buy a 5% bond. And every year you collect $50. And when you go back to your rep, to your broker, to your advisor, and you say, hey, I got the $50 over the 225 coupon payments, and I want to reinvest it. Let's not add much risk to the portfolio. I'm still the same investor with the same time horizon, tax objectives, liquidity needs, all that stuff, right? It's still me. And Aaron's got it. You've got to reinvest at 3% and sad face. Right? You need to see it. You're sad because your $50 is only earning 3% now. Oops. So reinvestment risk is the risk that when you have inbound money, interest, dividends, maybe capital gains, you can't redeploy it at the same rate of return with the same risk. Could I get 5% in this world? If I told my register rep, get me 5%, what happens to the risk I've taken? If I tell my rep, get me 5%, exactly, Cynthia, my risk has had to gone up, which is okay, but you now have more risk. Reinvestment risk isn't limited to just saying you have to take a lower coupon. You can always say, I'll take the same coupon, but the risk goes up. The same risk reward payout that we always are thinking about. So reinvestment risk manifests when rates go down and you need to put your money back to work. Get a lower return for the same risk or the same return, but at a higher risk. It's always up to you. So that's the counterbalance. So call risk and reinvestment risk are always kind of tied together. These are the risks that manifest when interest rates are down. You're going to bear reinvestment risk and call risk. Exactly. But when this happens, but just to tie it back to what we talked about before, when rates are down, what has happened to the price of your bond? Yeah, the price of your bond has gone up. So if you decide, you know what, I want to get out of the game, sell your bonds and you could make capital gains profits there. Let me just take a look through the questions here. Why does the 3% bond cost as much as the 5% bond? Well, it's not as much that the cost of these bonds is what we're looking at, but the return profile. The cost of the 3% and the cost of the 5% would both be, for our purposes, probably par value, because it's what a lender has to pay to get your $1,000 bucks. So if you wanted to, if Boeing right now wants to borrow money from you, you might say to them, I don't know, Boeing, you got the 737 MAX situation. You'd say to them, I don't see a lot of air travel and airlines are probably not going to be buying a lot of airplanes. So if I lend you money right now, I'm not sure I'm going to get it back. So you have to pay me 5% or 7% or 10%. Alternatively, if the Zoom company or the go-to training company, Cisco, says, we want to borrow money, you might say, I'm willing to lend you guys money at only 3%, right? So I'll lend you $1,000 for 3% because I think you're going to be making a lot of money because everybody's doing all their stuff virtually, and so you're in a really strong economic position. So in both cases, the bonds will cost $1,000, and it's the interest rate that will change to reflect the risk that you, the investor, lender, don't get repaid. So the reinvestment risk is, think of it from a fund perspective. Think about it, I'm a mutual fund or I'm Fidelity and I have $100 million of interest payments that come in every 6 months. I got $100 million of interest that I got to put back to work. So I'm going to have to buy more stuff with it. And that's what this is all about. All right, let me see what I got in the chat here. Tom V asks, why do we see liquidity frozen with not many refi issuances given the low rates? I think they're just backlogged for that. I think they're just backlogged. All right. Boeing is sketchy, you need a higher rate. Probably. Although we're going to see, we'll see if they get a full government backstop, in which case they're going to borrow for nothing. All right, what else have we got here? Gabriella asks, do long-term callable bonds have less call risk than short-term callable bonds? So the risk, the call risk, what do people think? Let me pose it this way. Does a long-term or short-term bond, both callable, have greater call risk, all things being equal? All things being equal. The long-term has more risk because the issuer is more likely to call to avoid basically to skip more high interest payments. Think of it this way. If you had a mortgage with 1 year left, you had 12 more payments and rates are now at all-time lows, would you refinance? No, you would say it's not worth it. I'd get a better rate, but only for 12 payments. If you had 20 years left on your mortgage, you would jump at the chance to refinance because you'd be locking in all those future rates. And so the longer the term, the longer the investment profile, the more likely the thing gets refinanced or called because of all the additional payments that can be made at the lower rate. So if you're just joining and you're on the chat here, I'm using the questions just more as a chat feature. So it's just kind of a running stream here because the chat feature is disabled when you get this many people in it. And I'm seeing why, because there's a little bit of a lag there. Let's see, we got about 10 minutes or so. I might run a little bit over. If you have to hop off, that's fine. But I want to spend a little bit of time doing these nominal yield, current yield, YTM yield to call. This is the face amount, right? The face interest rate. Does this change, yes or no? Change over time? Does not change. And on the discount bond, this is the lowest. And on the premium bond, this is the highest. The current yield, anybody remember the formula? This is a good formula to know. Good formula to know. Annual interest over current market value. That's current market value. Does that change? Does that change? Yes. By which variable? Which variable changes? The current market value changes. The annual interest does not, because that's based off the nominal. Yield to maturity. This is the return if held till maturity. It does change. You do not need to calculate on exam. And this is the return if held to the first, and that's the test point, call date. So bonds may have a couple of periods of time they could be called. Just for illustrative purposes, maybe it's a 20-year bond callable at year 5, 10, and 15. They have 3 trigger points. Right? Other bonds could just be callable starting at year 5, but maybe this is a bond that says we could call it at year 5 and at year 10 and at year 15. But if we don't do it at year 5, we're not doing it again until year 10. So the yield to call is the first call date. And what's the return you would get if it got called then? Discount bond yield to call is the highest. Right, this would be the second, and this is the third highest in terms of the yields. Over here, this is going to be the highest, and then it gets lower, lower still, and lowest. Okay. Eric asks if we get a question to rank them. Where is Eric's question? I lost it. If we get a question to rank these, how is it? I lost the question. Sorry about that, Eric. What's the best way to do that for discount premium bonds? So I think this is the best way to do it. You just kind of have to remember it. NY is nominal yield. CY is our current yield. YTM is yield to maturity, and YTC is yield to call. Bethany points out there's a couple of good illustrative examples, ways to kind of remember this. There's a pyramid kind of chart, there's a seesaw kind of chart. Different ones of different illustrations help different people. So do dive into the textbook and check this stuff out. We've got only about 5 minutes left, so let's jump in with let's talk about annuities just to get a taste here. There's a lot of stuff going on. Actually, I wanted to make a point about the current law, the CARES Act that they just passed, the stimulus package, did adjust and modify certain retirement plan rules that you're seeing in our materials. So it did things like eliminate RMDs this year. It did things like allow in-service distributions and early distributions without penalty. And I just want to say that for the exams purposes, for our purposes, forget all that. Those are temporary measures intended to do a stimulus package right now for the exam. I don't want you applying any of that to the actual test questions that you're seeing in our bank or on the real exam. When things like this happen, they typically ignore those because they're of a limited duration. So that's, this is for 2020 only. They made some modifications, and I don't want you bringing that stuff to the actual exam materials. So let's talk about an annuity generally, a variable annuity. What's the purpose of it? We'll talk about it just for a couple minutes here. What's the purpose? What can an annuity do for you? Remember, it's going to be retirement income, and this is the key point, for life. Super important that we recognize the annuity product is income for life. And the amount that you get in a variable annuity. All right, so we were talking about annuities. Will the payment amount vary over time? Will the payment amount vary over time? The payment amounts will vary. So if you buy this kind of product, when you say variable, you're going to be investing in the market to some extent. You annuitize and turn that pile of invested money into a stream, but that stream will continue to fluctuate as the market fluctuates. So if you had a variable annuity today, you happy about that or sad about that? It's already annuitized and paying you. What would you expect next month? Payments up, flat, or down? Yeah, you're sad, Lisa. You got it, Eric. This is rough for you, like everybody else in the market, because your payment's going to be down. If you had a fixed annuity, it wouldn't be this way. But variable annuity is the securities element, and that's going to reflect what you get. All right, so you're going to be seeing lower payments because the overall market went down. Now the payout options here, you can do different types of payouts. And I want you to just understand what's going to be the highest. So so it's a life period, period certain, call it a 10-year, or joint life. Either pay me until I die, pay for minimum 10 years and for as long and until death. So if I die after 3 years, payments for how many? 7 more, 10 total. Pay until I and my spouse die. So here's the thing. Which of these will get you the largest payment? Which of these gets you the largest monthly payment? Good. Highest payment. And this one, joint life, is the lowest payment because of the likelihood that the insurance company is going to have to continue paying for a longer period of time. That's what they're looking at. They just do an actuarial calculation. How many payments do I think I'll have to make? If I did this 1,000 times, because what they do, if I have 1,000 annuities out there, how many payments am I going to have to make? And if it's payments for death, it's the shortest number, so it'll give you the most money. If it's joint life, it's going to be the longest number of payments, so they're going to be the shortest. All right, I'm going to wrap this up with a final question here. Period certain. A little clarity on period certain. The period certain product and provision came into being because if you have just a life, you just have straight life payout option, and you die immediately after annuitizing, you get nothing. And people didn't like it. It just felt unfair. And so the insurance company said, we can deal with that. They said, we'll promise to make payments for 3 years or 5 years or 10 years, however long you want. But if that's the guarantee you want from us, if you're going to take away the chance that we, the insurance company, don't make a lot of payments, on average, we're going to have to make more payouts. So we're going to lower how much we pay you each month. If you think about an annuity that has $100,000 in it, and you have an expected 10-year life expectancy, they're going to say, all right, we need to make this $100,000 last for 10 years. If you die early, though, we get to stop paying early. If you live long, however, we're going to pay long. If you take away the insurance company's chance to stop paying early because you throw a period certain in there, they're just going to say, all right, on average, we're going to pay more payments, so each payment's going to be less. And that's the way that the period certain works. And it was something that people wanted. They just didn't like the idea of annuitizing, dropping dead the next day, and basically not getting any stream back from that investment. And so that's what they did. All right, everybody. Thank you so much for coming. I'm a little bit over. We missed some of the stuff, but like I said, check back in with Tom. I'll send out this recording. We're going to do it again next week, and we will get into some of these questions that I didn't get to last time. Thank you all so much. Have a great rest of your day, great rest of your week and weekend. Stay safe, follow the guidelines, and we will talk soon. Bye-bye, everybody.